Good morning and welcome to the World First Weekly Report for Thursday the 7th of July. Well, this week we've seen the RBA keep interest rates on hold. Governor Glenn Stevens and co kept the benchmark rate at 4.75%, and this is really consistent with the themes he outlined earlier in the year. Earlier in the year, Governor Stevens noted that they wouldn't have the necessity to raise rates until late 2011, and this was really due to the impact the Queensland floods were having at the time. Furthermore, global growth has not rocketed this year, and this leaves Governor Stevens with the ability to keep rates on hold potentially until early 2012, which is obviously going to put less pressure on the Aussie US dollar to go higher. The economic data out this week, however, may provide the pretense to raise rates before then, with a bit of a mixed bag when it comes to the local data. Australian economic data included a strong performance of manufacturing index, a strong ANZ job ads piece of data, and we also had the trade balance, trade surplus, that is, expand significantly. On the flip side, however, we did have some poor building permits and retail sales were also down. With global growth, like I said, being mediocre and a potential slowdown in China, this is going to provide the RBA with the ability to hold off on their monetary policy belt tightening. In the UK, and just covering the pound, we don't usually cover the pound in too much detail. However, with recent record highs being achieved against this pound sterling, it is important to note just where we are in their recovery. At the moment, the economic data is a bit of a mixed bag. Now, we didn't have the same sort of political collateral damage caused in the UK as they had it by their Atlantic neighbour. However, with the amount of austerity measures being put in place, we have seen a slowdown in growth in the UK. Because these measures were adopted early, we're likely to see growth in the UK economy to be mediocre but consistent, and we should see a continued improvement in economic data in the UK for the foreseeable future. The data out this week was a bit of a mixed bag. We did see their consumer confidence figure come off again. That's continuing to trend south. Obviously, less people spending money in the high street. That figure came out at -25. However, their Halifax house price figures, that may highlight that we're seeing a bottoming out in the UK housing sector, and we may see the economy in the housing sector start to improve in the near term. Overnight, the equity markets were subdued again for the second night in a row, with slight gains in the S&P 500. This was due to some weak data in the States. We've also got non-farm payrolls figure coming out on Friday, so that may be the redeeming feature we're looking for. And furthermore, China's central bank, they raised interest rates 25 basis points, and that's holding a bit of risk to the momentum that we've been achieving in global growth, and indeed hold a bit of risk to the Aussie US dollar cross, given that the Aussie is a high yielding commodity based currency. If you'd like an update on the market, or if you'd like to book a trade, don't hesitate to get in touch. Enjoy your day.